Welcome to the Nifty Noon Podcast. Well, if you were following the digital asset space this past week, that's September the 22nd through the 26th, 2025, you definitely saw some pretty wild swings. Both chaos and, honestly, some incredible ambition. Need the quick version. The TLDR is, we saw a major decentralized exchange war really ignite, then a huge, like, $1.7 billion market liquidation event that kind of reset things. Plus, some revolutionary, actually positive regulatory moves in the U.S., and capping it off, a stablecoin giant possibly eyeing a valuation close to $500 billion.
Yeah.
It was a lot.
It really was. It's pretty rare to see these four big themes, market chaos, intense competition, actual regulatory progress, and massive infrastructure scale, all happening basically in the same 5 days. So our mission here is to walk you through it chronologically, unpacking the key bits from the sources we've tracked to give you a clear, quick picture of how these, frankly, powerful and sometimes conflicting forces are shaping what people are calling Money 2.0.
Okay, let's dive in. Monday, September 22nd. Our newsletter flagged this as a nifty thought. The fight for decentralized derivatives, specifically perpetuals, just went into overdrive. This is really the story of Aster, which is backed by Binance affiliates, making a serious run at Hyperliquid. And the key number that jumped out was Aster briefly topping Hyperliquid in daily trading volume. We're talking roughly $793 million for Aster versus Hyperliquid's $462 million.
Right.
But this wasn't just random volume. It seemed very tied to token economics. That volume spike happened right alongside this crazy 800% rally in Aster's own tokens.
Yeah, that certainly gets attention.
Absolutely. It brought in huge profits for early folks and attracted massive whale activity, clearly chasing that momentum.
And the context here is pretty telling, isn't it? I mean, this project gets public praise from Binance's founder, Changpeng Zhao, and it's backed by YZ Labs, which is known to be affiliated with CZ. So the immediate read from analysts was, okay, this looks like a direct, well-funded competitor. Basically launched to claw back some of that decentralized derivatives market share Binance might have felt it was losing.
A strategic play-in.
Very strategic. It's about moving leverage, liquidity, and maybe even some brand loyalty onto their affiliated chain.
But we should add some nuance here. While Aster had that impressive daily spike, if you looked at the whole week, Hyperliquid still had a much larger weekly trading volume.
That's a good point. Hyperliquid uses this off-chain order book, which helps with speed, and they definitely still had the lead over a longer time frame.
So both are pushing things forward, but Aster's surge seems really tied to the power and liquidity within that BNB chain ecosystem.
Which does raise that longer-term question, doesn't it, about decentralization? Does Aster's closeness to Binance and its success through these token incentives maybe compromise that core decentralized idea a bit?
A fair question.
The Hyperliquid community often argues their setup is more fundamentally aligned with that non-custodial spirit. But philosophy aside, the momentum was undeniable.
And it wasn't just Aster. We saw related action, too. BNB itself hit $1,050.
Right.
That was a new record price, showing real excitement for that whole ecosystem's growth.
Right.
But that excitement, well, it got tested pretty quickly. If Monday was growth, Tuesday, September 23rd, was definitely about pain. The market just hit an air pocket, a big one. It led to the largest single liquidation event we've seen all year.
Ooh, yeah.
The numbers were kind of staggering. In just 24 hours, around $1.7 billion in leveraged positions got liquidated.
Billion with a B.
Yeah. And it hit over 400,000 traders. And get this, the vast majority, like $1.62 billion of that, was long positions.
Which tells you a lot.
It tells you people were really betting on prices going up, maybe too aggressively. Over-leveraged. Bitcoin dipped to below $113,000, but the alts got hit even harder. ETH, Solana, Doge. They tumbled like 7% to 12%. Ethereum itself dropped over 6%.
Yeah, it was rough. When you see that much liquidation, the first feeling is obviously fear. But, looking back, many analysts actually frame this as a sort of necessary evil.
A healthy reset.
Kind of. A healthy, though very painful, market reset. The thinking is the market got too hot, right? Too much open interest, too many derivative contracts open.
Okay.
So a big flush like this cleans out those highly leveraged players. It resets funding rates, brings open interest down. It's painful for those involved, absolutely, but arguably it builds a more stable foundation for the next move up. Better than having shaky hands ready to sell at the slightest dip.
Makes sense. A foundation built on something more solid than just leverage.
Exactly.
But what was fascinating, even amidst all that market carnage, the DX war just kept going.
Right. It didn't stop.
No. Our sources confirmed that even with the broad market suffering, Aster actually continued its run, surpassing Hyperliquid in 24-hour volume for a third straight day.
Wow. That shows some surprising resilience, or maybe just traders chasing volatility wherever they could find it.
Could be. Countercyclical liquidity, perhaps. Okay, so after the market chaos, Wednesday, September 24th, brought a welcome change of pace. Some regulatory hope, finally.
Yeah, this was big news.
A really significant and surprisingly supportive move for the crypto industry coming from the top in the U.S.
SEC Chair Paul Atkins, right?
Exactly.
Phew.
He announced clear plans for an innovation exemption by the end of 2025. He's calling it part of a bigger strategy, Project Crypto.
Okay, innovation exemption. What does that actually mean for companies?
Well, it sounds like a huge deal. The idea is to seriously lower regulatory hurdles, at least temporarily, give some breathing room from older securities rules that don't always fit.
For things like,
Specifically for new on-chain products. Think ICOs, airdrops, network rewards, stuff like that. It lets them launch and iterate while the SEC works on developing, more modern, tailored regulations.
this is actually quite proactive, a real shift from how things have often been handled, which was more regulation by enforcement after the fact.
Right.
This feels like a signal that the U.S. actually wants to lead in financial innovation, not just react defensively.
Yeah.
And it's not happening in a vacuum either, right? Congress is also working on its own crypto market structure bill.
Good point.
So if the SEC and Congress can actually get on the same page, well, the U.S. could potentially have a very supportive environment for digital assets, maybe even the best globally.
Okay, but let's inject a little skepticism. The devil's always in the details with regulations, isn't it?
Always.
The announcement is positive, sure, but the industry will be watching very closely to see how quickly these tailored regulations actually appear and if they just add new kinds of complexity.
True. An exemption is great, but clear, permanent rules are the end goal. The commitment needs to be there for the long haul.
Absolutely. And speaking of commitment and just sheer scale, while this positive policy news was sinking in, Aster's growth just went into another gear.
Oh, yeah.
Our sources noted its 24-hour perpetual volume blew past $11.8 billion.
Wow, $11.8 billion.
Yep. That didn't just surpass Hyperliquid, it left them way behind, at least for that period. It really cemented that initial surge into a sustained, if maybe temporary, market lead.
That's a staggering number for a DX.
It really is.
Yeah.
Okay, moving to Thursday. This brought maybe the biggest financial headline of the week, a potential valuation bombshell. Tether, the stablecoin giant, apparently exploring a massive fundraising round that hints at an almost unbelievable private valuation.
Oh, I saw whispers of this. What are the numbers?
So our newsletter sources detailed talks with investors to raise somewhere between $15 billion and $20 billion.
$15 to $20 billion.
Yeah. And reportedly, they're offering only about a 3% stake for that money.
Wait, so if you do the math, 3% for $15-20 billion, that implies a valuation of around $500 billion, half a trillion.
That's the math, $500 billion.
Okay, that needs context. I mean, $500 billion puts Tether in the same league as private tech giants like OpenAI or SpaceX.
Right.
And it completely dwarfs its main competitor, Circle. Circle's last public valuation was around, what, $30 billion?
Exactly. It's a massive difference. So where does this potential valuation, this confidence come from?
Well, it seems to boil down to two things. The sheer volume Tether handles and its incredible profitability.
Profitability.
Oh, yeah. Sources reported Tether made a net profit of $4.9 billion in Q2 2025 alone.
$4.9 billion.
Yeah.
In one quarter.
Yep. Mostly from the interest on the U.S. Treasury bills backing USDT. They've built up a huge war chest.
Okay, so they're printing money.
Basically. So this huge capital injection they're seeking, the $15-20 billion, the stated reason is to accelerate expansion. Things like their push back into the U.S. market with a regulated stablecoin, USAT.
But does a company making almost $5 billion profit in a quarter really need to raise $20 billion from outside investors?
That's the skeptical take, isn't it? Analysts are definitely questioning how effectively Tether could even deploy that much new cash without causing major market disruptions or attracting even more regulatory heat over market concentration.
So what's the other theory?
It might be less about needing the money itself and more about legitimization. Bringing in big-name institutional investors could help cement their status as a systemically important financial entity, especially as they try to launch that regulated U.S. product. It's a signaling move, perhaps.
Interesting angle. Okay, finally, Friday, September 26th, capping off the week, we saw a major new piece of infrastructure launch. Plasma. It's a stablecoin-focused Layer 1 blockchain.
Right. The mainnet beta and their XPL token went live.
And this wasn't a quiet launch. By any measure, it was huge. The network debuted with over $2 billion in stablecoin, total value locked, or TVL.
$2 billion on day one.
Yep. Immediately put them in the top 10 blockchains just based on stablecoin liquidity. And its fully diluted valuation, the FDV, shot past $8 billion. That's a massive jump from their initial ICO valuation of around $500 million.
Yeah, those are impressive launch numbers. But what's really interesting here is why build a whole new layer 1 just for stablecoins, right? We have layer 2s.
Good question. What's the vision?
Plasma is aiming to be the main railway for this Money 2.0. It's specifically designed to enable zero-fee transfers for major stablecoins like USDT.
Zero fee.
Wow, that's the architecture's goal. It's something current L2s still struggle with at scale because of gas costs for transactions. Plasma wants to eliminate that friction entirely for stablecoins.
That would be huge. And they also did something pretty smart to build community from the start, didn't they?
Yeah, that goodwill gesture was quite unique. They gifted every single person who participated in their pre-deposit ICO $8,390 worth of their new XPL token.
Regardless of how much they put in.
Regardless of deposit size. Even tiny deposits got that same amount. That's a powerful way to get broad distribution and buy-in.
Definitely create some buzz.
And if you connect this back to Tether's scale we just talked about, and the SEC's potential policy shift, Plasma's ambition starts to make a lot of sense.
How so?
They're building this stablecoin native neobank app called Plasma One. And think about the scale. Stablecoins settled over $18 trillion in transactions in 2025.
18 trillion.
Yeah, that number already surpasses the volume handled by giants like Visa and Mastercard combined. So a platform built specifically to capture a piece of that massive $18 trillion market, launching with $2 billion locked up on day one. It just shows the infrastructure is scaling incredibly fast to meet what looks like growing institutional demand.
Okay, so let's wrap this up. What does this whirlwind week mean for you, the listener? In just 5 days, we went from, intense AXX wars fueled by token pumps to a brutal market leverage washout, then a potentially game-changing positive signal from the SEC.
Right.
At the same time, Tether is maybe seeking a $500 billion valuation, while a brand new Layer 1, Plasma, launches with billions in liquidity, aiming to be the future rails for stablecoins.
Yeah, the keywords this week were scale, ambition, and surprisingly regulatory movement, all kind of pushing towards adoption, even if it means riding out serious volatility.
So what's the final thought to leave people with?
I think the really provocative thing here is the sheer pace of it all. How quickly will traditional finance, like the big global banks, be forced to really grapple with the actual realized scale of this parallel money 2.0 system? Especially when new infrastructure like Plasma can just appear and launch with $2 billion in real TVL, real money, on day one. The speed of development and deployment is just accelerating dramatically.
That is a crucial question. How fast does the old world have to adapt? Okay, thank you for joining us on this deep dive into the source material. We really hope this quick, consolidated look at the week's major moves was valuable for you. And if you do find these kinds of rapid crypto updates helpful, we'd love for you to follow our newsletter, Nifty Noon. You can find us on X and Substack for your daily dose.